In this presentation, we will enter an adjusting entry related to accounts receivable, sales, or the entry of an invoice. In other words, an invoice that has been entered after the cutoff date, but for which the work was done before the cutoff date, and therefore we should bring the revenue into the current time period within QuickBooks Online. For more accounting information and accounting courses, visit our website at accountinginstruction.info. Here we are in our Get Great Guitars file. To get a feel for this, we're going to take a look at our reports. So we're going to go to the reports on the left side. We're going to open up our favorite report first, that being the balance sheet. So we'll open up that balance sheet. We're going to change the dates up top to 01/01/19 to the cutoff of 02/28/19, the cutoff date, the end of the month of February, and run that report. What we're thinking about now is the accounts receivable, and when we think about accounts receivable, what is the detail for it? If we select that item, we'll see that we'll have invoices and sales receipts. That's what drives what goes into the accounts receivable. Note, however, that the invoice creation isn't necessarily when people owe us money. From an accrual standpoint, when people owe us money is, of course, when we do the work. So when we've completed whatever job we have agreed to do, that's when the money is technically owed to us, whether the invoice has been written or not. So from this standpoint, we can think of situations where we might write an invoice but not to the proper time period, and therefore accounts receivable may be incorrect as of the cutoff date. In other words, we have an accounts receivable balance over here of $10,449 as of our cutoff date, the end of the month, 2/28. It's quite possible that we enter an invoice as of March after this cutoff date for which the work was done in February. In other words, especially if you're talking about service businesses like a law firm or a CPA firm, it's possible that we have to count up the hours before we can send out the invoice. And in that case, then we might not send the invoice out until the following month. So we did the work this month, the invoice went out next month. But really, we should be recording the receivable in the month the work was done. If we reported these financial statements to the bank, we should be including whatever is owed to us at this point in time, whether we issued the invoice or not, because we should have entered the invoice because we did the work. That's what really drives when people owe us money. So to be on a proper accrual basis, then we would have to take that invoice and pull it back into the current time period to make the accounts receivable correct. Now you might be saying, what's the big deal? It'll work itself out. We sent it out in March. It'll be right as of March, 5th when we made the invoice. And that's true. And if we're a small business and we don't need to present our financial statements to somebody else as of the cutoff date, then that might be okay. And we might say, yeah, there's just an invoice. There's a bit of a timing difference. It'll work itself out. Not a big deal. However, if we're a large company and we want to make the financial statements correct as of the cutoff date, the date we create the financial statements and make the financial statements, or for a small company and we need to present our financial statements on an accrual basis, or if we want the best comparison of the financial statements, like we want to compare February to March, then that income should be in February. The receivable should be in February as well. So that's what we'll do here. This is one of those items that, again, small companies may not want to do. They may say, hey, it's not worth the added information I get to go through my invoices and see if I issued them in the right time period to get the cutoff dates completely right. But for larger companies that need to report this, for sure they have to do that. And for small companies that want the best, most accurate kind of comparison of data, then from month to month, then they should do this as well. So we're going to go back to the balance sheet again, and now let's open up the income statement and see the other side of this. If we right click up top, we're going to duplicate this. We're going to pull the left to the right so that we have the balance sheet on the left and we're working on the right. We're going to go to the reports at the bottom. We're going to make now our profit and loss reports, and we're going to make this for 01/01/19 to 12/30, or let's make it 02/28/19, and run that report. So January through February. We have the same issue on this side. So if we took a look at the sales, the revenue, the income, it's also created by invoices. So the same thing is true on the income statement, performance. If we did the work in February, we should have the revenue in February. if we entered the invoice in March, even though the work was done in February, then technically our financial statements are wrong for the performance, how we did for the month of February, because we did that work in February. So that's what we need to do. We need to pull that invoice into February. So to do that, we're going to create an invoice for March, the month after, for which we believe that the work was actually done in February, so we can see what that would look like, and then we'll do a journal entry for the adjusting entry. So we're going to say plus item up top, we're going to create an invoice. And we're going to say this invoice is going to be for Sam the Guitar Man, which is going to make up basically an invoice. So we'll say Sam the Guitar Man. That's the one we want. I'm not going to choose the job, just the customer. We're going to say the date of this is 03/03/19. So March, the month is after our cutoff date. So it's due, the due date is 4/2 according to net 30. And we're going to say that it's an ELP. So we actually sold a guitar. So it's an ELP. Epiphone Les Paul. ELP. That's the one we want. Okay, and we're going to sell one of those. Then we'll adjust the sales tax down here. I'm going to select the sales tax and make this a straight 5% for our example problem. So we're going to override the sales tax, make this 5%, and override. Confirm the override because other and override and close that. So now there's the invoice that we're going to have. Now we're going to say here that this is an invoice that we are sending out in March, but we did the work in February. Now what does it mean to do the work if we're selling inventory? What that means from a sale of goods standpoint is that we shipped the goods. We have done our job. The goods have gone out and they're going to be delivered. We've completed our component, our portion of the contract. And if you do like auditing or something like that, you actually might have to go in and look at the shipping records as of the cutoff date. That's one of the testings you can do. You can say, okay, well, if your job was complete, if the inventory is technically theirs at the point of shipping, then we're going to check the shipping document and we should be recording the inventory going down at the point of shipping and the sales being recorded at that point of shipping. If the point of, you have FOB shipping, FOB destination. We won't get into all that, but just note that we're saying that we completed our job, which is to give the inventory to either the shipper or the customer already in February, even though we didn't enter the invoice into March. And therefore, we should bring this invoice back into February. So we're going to go ahead and say save and close on this. We're going to say save and close. Now we're back on our profit and loss report. So we're back to the profit and loss report. If you haven't opened that, you can open up the profit and loss report. And if we see this, then now we're going to change the dates up top. And we're going to look at the month of March, the next month. So which is going to be 03/01/19 to 03/31/19. So the month of March, and run that report where we've entered this one item. So we have the sales related to that item. We have the cost of goods sold related to that item that we just input in March. Now, the problem is that it shouldn't be in there as of March. It should be in there as of February. You may be saying, well, okay, well then why don't we just go into this item and then we can change the date on it? And that's one thing we could do. But note that typically we don't want to change the date on the invoice or adjust the invoices because it's not good for basically the audit trail. So we're going to say we're going to keep the invoice as it is. We're not going to go in there and adjust the invoice or change the invoice. And we want to be careful to do that with invoices typically, of course, because they will be connected to the received payment items and deposits. So we're going to do what we would typically do in a full accounting system, not adjust the date of the invoice, but rather make an adjusting journal entry to bring that information back. So we're going to do that by entering this into an adjusting entry, and we're going to say, okay, I'm going to make an entry as of the cutoff date to pull the sales into the cutoff date, which means we're basically going to take the invoice journal entry and just enter it into the system as of the cutoff date. Now, as we do that, you'll note that then we'll have it in there twice because we'll have it in there as of the end of the cutoff and then again in March. So this is one of those areas that we would have a reversing entry, which we'll talk about later. We're going to make the financial statements correct as of the end of February, and then we're going to reverse it as of the end of March. So again, a lot of work to do this type of cutoff kind of journal entry, but it's there to make the financial statements most proper as of the date we present the financial statements, which is going to be the end of the month. Up until this point, we've been able to enter this information in with basically registers, not using journal entries directly, but this one's going to be a long journal entry, so we're going to have to go to the journal entries and actually use them. So to do that, I'm going to make another tab so we have the profit and loss on another tab. I'm going to right click and duplicate once again. We'll pull this one to the right so that now we have the balance sheet, the profit and loss, and now a new tab where we will make the journal entry. And so we'll select the drop down up top, the plus to the X, and go down to the journal entry in the others section. And now this is good practice because it allows us to just think through, okay, what's the journal entry when we make an invoice? What are the debits and credits? So we'll practice debits and credits. If you don't know debits and credits, you can think about just ups and downs, what account is going up and down, and the fact that this thing has to be in balance. So we'll have debits and credits balancing. So we're going to say, bring this down to the cutoff date, all of our adjusting entries as of the cutoff date, the end of the month of February. So first we know that when we make an invoice, accounts receivable goes up. As we've been talking, every time we make an invoice, we said, okay, that means accounts receivable is going up. So the first one is accounts receivable is going up by the sales price plus the tax. We sold it for $500. That's how much we sold it for, plus the tax of 25 or 5%. So accounts receivable went up $525 with that invoice. So we're going to pull that invoice into the cutoff date, the end of February. Again, it's going to be in there 2 times, but then we're going to reverse it as of March 1st. So this is just to make the cutoff correct. Okay, so then we're going to say adjusting, I'm just going to a date adjusting entry, and I'm going to copy that. Now, anytime we do something with accounts receivable, we also need a customer, and that was Sam the Guitar Man. If we don't have a customer, then the QuickBooks won't let us post it because it's going to say, hey, I need a customer so I can make the subsidiary ledger correct. So we're going to type in Sam the Guitar Man. That's the one we want. And then the next item, the other side of it, is revenue, sales, income. We're talking about things in inventory. So we're going to have the sales is going to be our second item. So we'll say sales is our second item, but it's only going up by 500, which are sales amount, the amount we get to keep, not plus the sales tax. So then we don't need a customer usually for sales. And then the difference of the 25 is going to go to the sales tax payable, and that'll put us back in balance, which we're going to call the New York Department of Taxation payable, or whatever they call it there. So basically sales tax payable, and that's the 25. So now we're in balance, but we haven't recorded the other half of this, which is the inventory going down, the related cost of goods sold. So I usually think of inventory first, but the cost of goods sold will typically go on top. So we would be cost of goods sold and expense related to the inventory of 400. And then the other side, inventory going down. Inventory going down. And that's going to be a credit of 400. So note, this is the journal. This is what the system is doing every time we create an invoice. It's doing this. And note, all this is happening with us not knowing anything. We can provide this information to someone to just enter invoices, and this is all happening kind of behind the scenes just because of the way the system's set up. But this is what's going to happen, so it's good to do these adjusting entries because it helps us to see kind of the behind the scenes of what's happening a bit. So we will then record this. Let's go ahead and say save and close. Save and close. And then we'll go back to our financial statements. I'm going to go to the profit and loss now. And the profit and loss is really kind of what we typically think of as why we do the adjusting entries, because we're really looking for the income, performance, how we're doing, how we're measuring ourselves over time in comparison to other time periods. So in this case, it's an unfair measurement. That's why we made the adjustment, because the revenue that we have in March is not fairly allocated to March because we earned it. We shipped the inventory in February. So to have a good comparison, a correct comparison on an accrual basis, on a performance standard, we should bring it back to the prior time period. And that's what we're doing. So we'll then adjust the date back up top from 01/01/19 to 12/31/19. I'm sorry, to 02/28/19, the cutoff. so the end of February, and run that report. And then we'll see here that we have the sales of the 500. Now note, I should have put it into this number, sales of product income. So we have those two sales items again. I'm going to go ahead and adjust that now in the same way we have before. Take this opportunity to go into the 500. Select that 500. There's the journal entry. Select that item. And then we're going to go and make this not sales. I'm going to make this sales of product income. So slightly, same type of sales. It's an income account. And then let's do that again. Save and close. And then scroll up. We're going to go back to our profit and loss. And that'll take it to the sales of product and income. So again, QuickBooks allows us to give us that kind of adjustment pretty quickly, which is nice. If it didn't allow us to do that, I'd have to enter another journal entry to take it out of the one sales account and put it into the other. So there we have it. So we have the sales are increasing as of the cutoff. That's what we want, because the income, the performance, how did we do when we're running a race? If we have a stopwatch and we're trying to see how we're doing, this should be increased by the 500. We got it in there in time. It was done before the clock was over. It's just that we didn't record it. So to make a proper measurement under an accrual basis, it should be in there if we had done completed our job, if we shipped the inventory. It's not really based on the invoice, in other words. That's just the best thing that QuickBooks has to be able to trigger, but that's not really the cause of us earning the revenue. Just making an invoice doesn't mean we earned revenue. It's the completion of the work. So then we're going to go back. The other side is going to be on the cost of goods sold. So here's the cost of goods sold side of it. And that, of course, is the 400. So if we select that item, it's a journal entry. And we'll be able to see those journal entries by just basically labeling them. And there's the 400, the cost, less than the sales price, which was 500. And then the other side is going to be on the balance sheet. So if we go back to the balance sheet, we're going to say run that report once again, refreshing it for the cutoff date. And we know that under accounts receivable now, it should have increased. So again, even though here it is, the 525 for the full amount, the sales price plus the 25 for the sales tax, even though we didn't issue the invoice, people really owe us money as of that time period. So even though on these adjusting entries, we're typically concentrating on the profit and loss performance, the accounts receivable would be more fairly stated with an increase in accounts receivable as well. If we go to the bank, we should be telling them, hey, people owe us another 525 because we did the work. Yeah, we haven't invoiced them yet, but the invoice is not the process that we do to complete the job. They owe us the money not because of the invoice. They owe us the money because we've completed the work, what we've been contracted or what we've agreed to do. So then we're going to go back. The other side, of course, is going to be in the cost of goods sold. The inventory. Cost of goods sold on the income statement or profit and loss. Inventory. So there's the inventory. If we scroll down, there's the journal entry. Inventory is going down by the cost, the 400. And then if we scroll back up, we're going to go back to the reports, and the last component is in the sales tax payable, it being called New York Department of Taxation and Finance Payable, because that's the department we're going to be paying in New York, but it's basically just sales tax payable. So we've entered that journal entry, and what we've done is we've pulled it into the cutoff date. We've pulled that in. Again, a journal entry that a small company has to weigh. If you're not giving your financial statements to somebody else, if you're not presenting them to a bank that needs them on an accrual basis, or presenting them to investors, or if you're not a company that needs to do the monthly financials, you might say, hey, that's not really worth it. I'm okay with it being off by that kind of timing difference, even though it does distort my comparisons from month to month a little bit on an accrual basis. My stopwatch isn't perfect. My stopwatch, when I'm measuring how much I run, how fast I run in a certain time period, isn't perfect. That's okay. It's good enough for my decision making, and I'm okay with that. Then that's the decision you can make. But to be on a perfect accrual basis, and when you need to do that, and when you need to present your financial statements to be correct as of the cutoff date, then we should be doing so by making sure that we have a solid cutoff and seeing what income is applied to the proper period based on an accrual basis, which is, of course, when we do the work. For more accounting information and accounting courses, visit our website at accountinginstruction.info.